Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to do the Frac Spread show, and I'm going to try to mix in some stuff from the EIA, some stuff from the Econ show, because obviously we didn't film them this week. I will be back in the saddle next week. Everything's back to normal, so we'll have our EIA show, our Econ show, and then obviously our FSC show. So our things we'll get back again and again. We'll talk about some things, but I'll go deeper into it next week and try to catch up and then look at where things are going. Obviously, we've seen, or if you haven't experienced it, the market continues to be in free for all. And a lot of this is just a culmination of things that we've been talking about, pressures that we've seen that are leading to this. And just given the way Friday is closing, typically that leads to another meltdown on Monday as people get additional pressure. You know, we will have the Jewish holiday starting off next week, which that typically also leads to more pressure in terms of just less volume. As volume is reduced, that typically makes the market move even more. So we're going to continue to see a lot of these shifts in general. So some of the key things that we want to talk about today is obviously the Frac Spread show, and we had an increase of 1. So we went from 287 to 288. And again, so that slow grind up, and even as the market deteriorates, as pressure continues to mount, it's important to understand that there's still demand for product. Like when you look, our exports are still holding over 3.5 million barrels a day on the crude side. You know, natural gas or LNG, I should say, continues to move into the market. So even though you're starting to get some of this pressure on the front end, the curve is still there. And one of the things that we talked about last week before I left for London was that we would see a little bit of contango start to kick in. And I think contango is going to start to become more pronounced, but you are seeing more pressure on the crude demand front as margins get hit in Asia. So there was an increase of refined product exports from China. There was a new export quota that was issued, which essentially takes you to just over 1 million barrels a day available for export through year end, which is what we were saying. What we were calling for was that you were going to start to see China essentially try to unload a lot of this product, just because they have to try to balance their system because they have a lot of crude in storage. They have a lot of product in storage, so you have to clear the product to increase those runs. So that's why when you look at the U.S. and U.S. completion activity, we're starting to get to kind of that happy median where we should be closing in at about 300 and then really kind of hold in at those levels. That should be enough to keep us really around that 12.3, 12.4 million barrels a day, you know, getting to that exit rate that we've been talking about. Now, when we look at the number of tankers going to China is at 87. So we had a little bit of a bump. Now we're starting to see some of that slowdown. But 40 super tankers are now targeting the U.S., which is the most since May 8th of 2020. And that's an increase of 5. So when you think about what the U.S. is doing, they're exporting light sweet and now importing more of that heavy sour just because we have a lot of those opportunities, a lot of that optionality. With 14 vessels heading to India, a gain of 6 from last week, which is the highest since August 19th. So again, China continues to be that odd man out. You're seeing later that demand just isn't there, while the U.S. and India continue to try to take advantage of some of these opportunities. So out of West Africa, we have Nigeria and Angola struggling to kind of close out October, but November starting off strong. And we saw something similar where companies are going to try to pick off some of those lagging barrels, but then they'll come out and they'll buy fairly strong within the first week or two of that November. But then again, as that drops down, that's when you'll see more pressure on differentials. So when you start looking at it overall, Angola's final shipments for crude October are proving slow to find buyers. But November cycle is already starting off fairly strong, but it's just because of pricing in general. Like we've seen differentials come down. Nigeria's cut OSPs again, just to, trying to push things through. Unipec and the IOC are both showing more interest in November cargoes, and differentials may head higher as a result. But that's what we were talking about, like that we found a little bit of a floor. and now that floor is being carried in November, but we should see some of that pressure in October just to kind of clear some of those what's remaining. And that's because we will get a little bit of that bump in November along the lines of seasonal increases. 3 to 4 cargoes of Angolan crude for October loading are still unsold out of the 32, and they'll try to clear that ahead of time. So we do expect to see some steeper discounts just to clear it. Between 12 and 15 shipments of Nigerian crude for October loading are yet to find final buyers. So when you start to look at where some of those increases, we should see some of that move. Some of those cargoes that we've talked about that are now heading to the U.S. are originating in West Africa. So we will see some of that, while the Middle East had another increase in floating storage just because of, again, the dynamics on pricing. And as prices fall again, that will help incentivize some of these additional cargoes to get back into motion, as Congo still has one left to sell. So again, it's kind of a mixed bag, but when you look at the global market versus the U.S. market, light sweet still has that demand going into Europe. Light sweet from the U.S. still has that demand going into Asia. So even as you see a lot of this back and forth, we're still seeing that demand for U.S. crudes holding our exports at about 3.5, 3.6 million barrels a day. Now when we start looking at when we look at where things are, here you can see that the gas rigs are down 2, oil rigs were up 3. But just to be more focused on in terms of where things are, or the horizontal dropped by 2, vertical were up by 2, directional was up by 1. But again, that horizontal dropped. So that's one of the things where we're starting to get some of that balance, but a lot of it was driven by gas. So typically you see some of that slow down in the gas side, and then you start to see some of that pick up as we turn around. The Permian's still going to continue to be that motivator for this product, especially as we have completions continuing to be fairly strong. So Singapore, when we look at global refined builds, and this is something, again, we'll talk more next week. So Singapore had a build, what they previous in terms of just the refined product went from 43.5 to 47.1, all of that being on the residual side. And that's one of the things where light distillate resid is where we see some of that elevated amount, with middle distillate staying fairly flat. But as you have that Chinese product coming back into the market, that will help push both light and middle distillate a bit higher. Light will be the problem as gasoline continues to be that overhang. And as you get those crack spreads shifting down, that's going to cut demand even further when you look at the oil demand in general, as refiners, have economic run cuts. So not only do you have the seasonal slow period, but now you have that new product coming in, putting pressure. Out of Europe, you can see here that gasoline had a small draw. Gas oil had a small build. But again, you're still seeing at these elevated levels. But that Chinese product, we not only will, as it goes into Singapore, some of it will come into the Atlantic Basin. But as more of it also goes into Asia, it'll displace other cargoes, and that will help put more product into the Atlantic Basin. You'll see some additional imports on the distillate side into both the East Coast, as well as into the European markets. When we look at crude in the U.S., crude had a small build of 1.14 million. When you factor in the SPR, there was a draw of 5.76 million. But now when you start looking at the Chinese movements, that's again going to displace some of this crude. And not so much that it's going to hurt U.S. exports. It's just going to open up more imports for the U.S. just because we'll be able to pull some of this down. You'll see some of the Asian buyers going away. That'll push differentials down a bit, and that will enable the U.S. to buy at a little bit more of a discount. Implied demand, when you look at just the products in general, so gasoline continues to remain fairly weak. We have it at about 8.5 million, so we're still at above where they're showing, but again, still at a depressed level. Distillate, again, fairly balanced. We don't see that changing all that much until we get further into the heating cycle, and we'll see some of that demand pick back up. Now, one of the bigger issues that we're seeing is and it comes down to when you start looking at gasoline and diesel prices, So we've continued to have refinery hiccups, which have resulted in fires, in shutdowns, in partial shutdowns. And as that happens, you're going to lose some of that oil demand, but you're going to also support some of that pricing when you look at some of the activities. So gasoline has actually started to stabilize a bit, and that's going to keep diesel, which has fallen to about $4.91. But as we were saying, we think that $5 is going to kind of be that floor, and we are going to average that, especially as we head into the winter months. And that's, again, more of that impetus to see that inflation remaining a bit elevated. Now, when we look at gasoline demand, when looking at just activity, so China remains elevated as it's bounced back up. Google mobility for Europe remains elevated as well as areas in the Asia Pacific, with the Americas being fairly flat. The TomTom congestion showing that there's more strength to come in Europe as things remain fairly stable on both the Asia Pacific and on the North American side. And again, it's just going to be a matter of when does some of those economic pressures really start to hit on the Asian Pacific side. And clearly, they really haven't started yet. You've seen uprisings, you've seen some socioeconomic problems and protests, but it hasn't really resulted in much of a slowdown. So soaring gas prices will continue to hit fertilizers. So here's just looking at, and this is just carrying on the conversation that we had in London, where I went to the World Ag Tech Forum. And fertilizer was obviously a big component of what we were talking about. And here you can see just the amount of fertilizers that are offline, how much that's accounting for. And that's just increasing the pressure that we're seeing as we go into not only just the end of this year, but also into next year. And that's putting more pressure on food, again, more pressure on prices and supporting that inflationary drive. And now you have the UK, which issued, I think it's the largest tax cut since 1972. But when you look at fiscal versus monetary, the Bank of England is raising rates. Now that you have the government essentially increasing financial stimulus, which is going to be a bit more of a problem on the inflation front. Now, the one thing that we've said about the Fed is that they're going to continue to raise rates. People have doubted us. Everyone said we were crazy. When I said that the 10-year was going to be over 2.5%, 3%, and actually 4%, people thought I was insane. But again, the Fed's raising rates, and everyone is overestimating the Powell put, because the Powell put doesn't exist at these levels because, and we'll show some of the data, the data is slowed in the US, but it's not in a depressionary setting. Like, you still have a fairly strong employment market. You still have things that are now contracting, but not collapsing. And that continues to give them the opportunity to raise rates and to continue to try to get in front of inflation, with inflation surprising to the upside. PPI surprising to the upside. Our import prices surprising to the upside. All of that is keeping that inflationary pressure there. And as long as the data continues to support rate rises, you're going to continue to see it. So we said the 75 basis points, we see another 75. And then the two after that, we see at least 25 to 50 basis points that are going to carry us into 2023. They're not going to reverse course. There's still more upside to rates. And again, that's going to put more pressure on the market. So now when you look at the global flash, the improvement, US PMI with composite was up to 49.3 versus the estimate of 46.1. So again, you're still seeing it's still contractionary, it's still below 50, but bouncing along. Manufacturing was up to 51.8 versus the estimate of 51.5. Which again, the services was the one that surprised the most. We expected manufacturing to kind of hold in just at that expansionary level, but services had that big bounce from 4 to 49.2 from the estimate of 43 points, from the prior of 43.7. And then new orders have returned to expansionary territory ever so slightly. But this is something that we want to dig in more next week, because, okay, when does the floor drop out? Like, when do we really see this accelerate? And it's really going to be based on the consumer. And the consumer is the one that we've been honing in on, and we'll talk more about that again next week. So then when we turn to the Eurozone, just because we want to look at where some of these pieces are, the deep Eurozone, there's going to be a deep recession, and if anything, you could even call it a depression, where there's the forecast that GDP growth is going to drop to negative 2.4% in 2023. I think there's more downside to that, with the peak to trough drop of over 4%. Today's flash manufacturing PMI data for September kind of bears out something similar when you look at the forward-looking orders minus inventories, which have gone deeply negative. And that's where, again, when we look forward, we see a lot of that pressure, and that is that leading indicator that just shows where things are going, the PMI, how it's heading overall. But even as you get that slowdown, even as you get that economic drop, you still have to look at the PPI. PPI is showing that upside. You're seeing more of that pressure. So when you look at Germany, inflation pressure rising strongly. PPI is accelerated to 45.8% in August. Year over year from 37.2 in July. It's the highest price increase ever since the start of statistics in 1949. So when you look at just, again, that flow through, there's so much pressure, there's so much increase. So compared with the preceding month, PPI jumped by 7.9% in August, also the highest increase ever. So not only did you get the biggest bump, which remember we said August was going to be ugly because of diesel, because of electricity, but we don't see that adjusting all that much. Again, keeping that leading indicator on CPI moving upwards. Now, when you look at the U.S., the American lunch is expensive. The staple food items have surged by double-digit percentage points, with lettuce leading up 33.5%. So it's not just Europe that's seeing this. It's, again, the U.S. side. On the food front, food is going to continue to be the biggest overhang when you look at fertilizer shortages, when you look at how silos continue to run dry, keeping some of those pressures in there. So the latest housing data. So we'll look at this, then we'll look at debt, and then again at some of the more intricate housing data. Latest U.S. housing data caused the indicators for these indicators here to fall well below trend and into the sharpest decline since March 2007. The Housing Activity Index, which has historically led home prices by 1 year, now points to a fall of home prices by 5.5% year on year, which we see accelerating into next year, which is one of the reasons why is because people are under more and more pressure, with the 30-year mortgage now well over 6%. Now, when you look at credit card debt, consumers are struggling with long-term credit card debt. 60% of debtors say they have been in credit card debt for at least a year per the survey, up from 50% a year ago. Share of those in debt for over 2 years has climbed from 32% to 40%, which is a bigger problem as you have rates moving higher. So your credit card debt has gone from 16.99% to 20.99%. So you're seeing this huge shift up. So the cost of what you're borrowing is only going higher, again, bleeding from savings, taking that additional income and going towards just managing this debt, which is rising at an accelerating rate. And it's exponential, because when you look at the leverage factor for every dollar up, for every percentage point up, you have to think about what does that do to the underlying spending side and how are they going to maintain. And this is what we're seeing. This is where we see the bigger crack, and that's going to push us down on and that's why with the consumer, as we always talk about it, it's slowly and then all at once. And this is where we see a lot of this acceleration to the downside. Now, 6 consecutive monthly declines for the Conference Board Leading Economic Index, which is rare to see outside of a recession, which again is why we see that recession coming through. The leading indicators are leading coincidence peer lower. Ratio of LEI, or the leading economic index, to the coincident economic index has rolled over sharply, adding to, again, more recessionary warnings when you look at some of these different pieces. So we even though we've stabilized and we've seen some of that flatlining in a contractionary standpoint, we see this, again, accelerating to the downside and more pressure to come. which is why when you look at the level of financial conditions aren't quite extreme, but relative to the 5-year average, conditions are the tightest going back to the great financial crisis. And then when you look at bond volatility, we are now much closer to 150. We're seeing that acceleration, but remember, we've never really gotten below 100. We've seen a lot of bond volatility. And normally when you have bond volatility, the Fed will launch QE in order to bring some of that down. Instead, they're still rolling out quantitative tightening because they have no choice. They waited too long, rates were too low, inflation was too high, it's still too sticky, and they want to avoid a wage spiral, and that's why we're going to continue to see that tightening and those problems. So this is only going to continue to get worse, which is why the 30-year mortgage rate now back to late 2008 levels of 6.02%, moving, depending on the ratio and what type you use, it's much closer to about 6.3%. August existing home sales came in at negative 0.4% versus the estimate of 2.3. Inventories has risen to 3.2 months versus 2.6. Median selling price is still 7.7% year on year at 389.5. So you've seen some prices come down, but still elevated. But those home sales are flatlining. And again, we see the flat line, and then we expect that to drop again just because there's the seasonality. There's also just less and less people out there who are willing to buy, especially as rates go higher. Now, when you look at the multifamily housing starts under construction, units under construction have a component within multifamily housing starts continue to surge and is now at the highest since November of 1973. So one of the things that we've been talking about is that we expected to see multifamily housing starts going higher because construction companies want to diversify some of their costs and try to diversify some of their revenue, because revenue is going to become an important piece as they try to pull more revenue in and diversify away from some of the losses that they've had on the single family construction front. But that's why when you look at the massive divergence, August housing starts were up 12.2% versus the estimate of 0.3%. Why? Because as the supply chain is caught up, as there's more inventory there, they're trying to move some of this back in and try to get some of these starts going at a lower price, adjust the footprint a little bit, and try to keep some of those flows coming through. But the permits, the building permits, that was down minus 10% versus the negative 4.8% estimate. So permits will drop and construction will start to pick up a bit. But again, that's addressing the inventory problem, because everyone keeps saying, oh, well, there's not enough inventory in the system. It's like, but there's a ton of new construction. And that as that comes online, as that comes through, that's where we're going to continue to see a lot of those additional housing starts, both the multifamily side, which will help also address some of that, as well as some of this new construction as they try to, again, some of this and on the housing starts is a sunk cost. So now they have a choice of take a loss or just get started and try to do what you can. And that's why they're going to shrink the footprint and try to get as much available, but again, slow down on the forward side. So that's where we have a lot of this back and forth. But the housing side continues to worsen, the credit side continues to worsen, and that again will lead to more pressure on the economic front. So that's what we have for you today. Hopefully you have a great weekend, and we'll pick it up next week with our normal schedule. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.